Okay, good morning.
I'll give it back to Logan.
It is great to see all of you here. My name is David Zarling. I'm one of the partners and head of investment strategy and research at Client First. And I think I have to stand maybe here
Back up.
or here.
Yep, right there.
Okay, so I'm the test pilot for the planning team, so where they need to stand. You can see all the nervous energy over there. They're really excited.
Yeah, buddy.
I'm a little bit nervous. My mom is sitting in the front row. So I'm glad I don't have to be up here the whole time. Some of you might know that in my hobby in my life is coaching. So I like to get my players' brains going. I want to get your brains going. So I have a trivia question. 50 states of the United States, which state is the flattest? Don't be shy. Mama?
Nebraska.
Kansas? No. Oklahoma? No. Iowa? No.
Florida.
Nebraska? No.
Florida. Florida.
Illinois? No.
Florida. Florida.
Who said Florida? Ding! Florida, the flattest. I mean, it makes sense, the Everglades and everything, it's just super, super flat. I don't know, when I was looking up, I said all the states that you guys said. I also was wrong. But a big topic for today is going to be the one big, beautiful bill. Someone take a guess how many pages that bill was when it was signed by President Trump on July 4th. Okay, I got a lot. 1,000?
2,000.
2,000, 3,000? 985. We're getting closer. So about 870 pages. Raise your hand if you read everything. Okay, that's good. Even in the age of AI, you plug that bill into AI, and guess who found problems with that bill? This team. Not problems with the bill, but the AI result. Okay, so this team knows what they're talking about. It's why I'm up here, standing up here, edifying them. I see them operate every single day. They are fantastic for our clients. When you think about taxes, one of your biggest expenditures on an annual basis is that check to Uncle Sam. And that's what these guys are good at, is helping you navigate tax law. In 870 pages, they're going to cover the important facts that you need to know out of it today. So the whole planning team is up here ready to go. And first up on the docket is Justin Krieger, our head of financial planning and also a partner here. You're going to get to know the team and talk about the one big bill, but please give a warm welcome round of applause for our financial planning team.
Okay, we always like to do a little update on family time. So we've got some fun time up north with the family up in Boulder Junction this summer. We've got some fish from Canada, 3 muskies there. We caught 28 between our 2 groups. I'll come back to this fish to end up because that's the best story up here so far. So we've got my wife that teaches at Kettle Moraine Lutheran High School, and now we have 3 high schoolers in the house. We got a freshman and 2 seniors. We now have, we had to put down our female German long-haired dog last fall, but we got his great-great-grandson there. He's about 40 pounds at 4 months, so he'll be about 80 pounds, and then my wife's dog's about 13 pounds, so now we have 2 puppies in the house. So anyways, that's an update on my family, but the fish story is important. So this fish is my personal best 45.5-inch tiger muskie caught on a lake in Canada. And the fun part about this is the main lake point that I caught it on, the last 4 trips up there, I've had fish and lost, had them on, had hooks in them, lost them. So it's just like every year, there's always fish on there. I get them on, lose them. This year, I didn't lose them. I caught a 45.5 and a 43 and a, oh, actually last year I caught a 43.5 on the point. This year I caught a 45.5 and I think another one. So the point is no longer cursed for me. I have my personal best, biggest tiger muskie. So,
Wow.
I mean, it's not quite as important as family stuff, but it is. It's like a 30-point buck.
That's really good. In my family, we hear about muskies, and I thought that you could eat those fish. So every time he comes back from a trip, I found out one of my uncles said you could eat it. The other uncle said you couldn't. I don't get involved anymore. So if you guys want some fish, he doesn't have any because you can't eat muskie. Things you learn. Anyways, back to the other sports. So this is me and my wife. This was the final chapter of a golf journey for me and my kids. So I was coaching. My son made it to the state golf tournament, and that was our picture there. I always say I get my wife back, so we've been doing a lot of fun. This is a 5th floor rooftop patio bar looking over downtown Milwaukee. So we tend to go for big walks and have some fun. And then my other 2 boys, Brad Bachhold, who used to work a little bit on our team, we went down to play golf with him on one of the days off for when the market was closed.
My name is Cade. If you ever see Brad not put a picture of golf in his slides, just know he's on the decline, so we might need to check in on him. So, yeah, my name is Cade. I have a few pictures up here. First one on the left, that is us at the Brewer game. We took a team outing to the Brewer game. I think that was towards the end of June, I believe. So we have Ethan way on the left. Ethan is a part of our insurance team. He didn't make it out today. Jeremy, the one right in here, he is one of our accounting interns. We have Logan, third one to the right over here. And then myself, Logan and Jeremy were just recently turned 21. So it was a fun day. They got into some Coors Light, some spotted cows, so that was a fun time. Right in the middle, I have a picture of myself and my girlfriend. That was my first time going to Alpine Valley for a concert. So we saw Tyler Childers. If anybody knows who Tyler Childers is, he does like a lot of like folk country. So that was a really cool concert to be at. It was so hot in there, and they don't sell you like individual water bottles. You have to get like $24 huge cans of water, so that was not fun. And then finally, way to the right, I am in no way, shape, or form a fisherman. So I leave that to Justin and Chris. But we had the opportunity to go on a bachelor fishing trip or fishing outing in Sheboygan. I don't get up to Sheboygan that much, but it was a nice area when you're on the lake. So we caught a bunch of coho, I think there's coho salmon, I think they're called. Yeah, caught a bunch of those bad boys. So that was a fun trip to be on. So yeah, that's a little bit about what's been going on. So I'll hand it over to Logan.
Yeah, my name's Logan. I hang out with these guys every day. It's pretty awesome stuff. First picture here on the left. In May this past year, I proposed to my girlfriend, so we are now engaged. So that's been pretty awesome. We're gonna get married next July. Thank you. Yeah, super excited about that. So we're doing long distance right now, and that'll be done next year. So here we go. Middle picture is we'd like to do a little fun golf outing with my family and another family. So that was us. We had matching uniforms there in the summer. That was real fun stuff. And then there on the right, I just went to go see my fiance earlier in September, and we went to a really cool hot air balloon festival in Colorado Springs, Colorado, and that was a ton of fun.
I'm Dominique. It's been a pretty awesome summer. We were super busy. So I'll kind of go in the middle is that we took a big family vacation out to North Carolina to the Outer Banks. I almost forgot what it was called. Took a week long out there. If you've never been, highly recommend it. It is the most beautiful beaches. The people are so friendly. Very huge retirement community. So that was a lot of fun. And then in the middle, Ragnar opened a new water park, inflatables. So I attempted to do that with my girls. I made it for about the first 15 minutes, and that was about all I could handle. On the far left we're huge dirt track fans, so I don't know if anyone knows who Bill Baylog is. He is one of the only Wisconsin drivers that is with the Outlaws. We follow him around and do a bunch of traveling. So he came to Plymouth, Wisconsin this year, so we got to meet him, and the girls were super excited. And then back to school, I now have an 8th grader at Morningstar and 6th grade, Kaylin and Anna. And that's what we've been up to this summer.
All right, I'm Chris. In case anybody didn't meet me before, we had a wonderful year this year. We finally kicked our last kid out of the house. The first picture is my wife and I, and then our son Lev. Lev is currently getting his body all sandy in boot camp in the Marine Corps in San Diego. He's got a lot to learn, so I am hoping he's enjoying his lessons. Middle picture is every year my family and I, we go to Canada fishing. My dad is the far one on the left. He originally took me as a kid, and we've tried to go every year since then. Somebody in our crew has been going to the same spot for over 50 years. The rest of the people are my two sons, and then one of my sons, Jack, brought his friend Ed along. My wife's in there. We had a blast every year. It's amazing. We did not musky fish, so we did keep fish. And we ate a lot of them, too. And then on the far right is my daughter Grace in the middle. She graduated from cosmetology school at Aveda in Milwaukee. And then my son Jack next to us. So it's been a great year, and just enjoying the empty nest life, and trying to keep my wife happy. That's a full-time job by itself.
Hello, I'm Katie. I'll start in the middle. This is our family. We had 4 weddings this summer, so we were pretty busy going to those. That was at my cousin's wedding. Back to school, I have Owen in 5th grade at Morningstar, Ellie in 7th, Gideon in 3rd, and then we have a high schooler this year. She's a freshman. Lena's a freshman at KML, so she's been having a lot of fun with that. And then on the far right, we took our boys to their first Brewers game, so they were very excited. They got a couple balls, and that was the night before the terrible rain. So we did not get stranded down there, but they had a blast. So that's us.
Hello, my name is Emily. The middle picture is our yearly family trip up north to Lake Namakagon, my favorite place in the world. That's me and my husband and our 4 kids, and then my son's girlfriend over on the right. So that was 4th of July, so we were a little decked out for the 4th. And then we did have a very nice summer, but it was great to get all our kids back to school. So on the left here are my 2 oldest. They go to Wisconsin Lutheran College. Eli's a junior and Ava's a sophomore. And then over on the far right are my 2 youngest, and they both go to KML. Lydia's a senior and Micah's a freshman. So it's nice to have them all back at school.
So yes, I'm Sarah. My latest family picture was pulled together in about 5 minutes in our backyard because everyone happened to be home at the time and Anna needed it for school. So I have a senior at Northern Michigan University. She'll be graduating in May. A sophomore at UWGB, and Anna is a freshman at Kettle this year. On the left, this is my youngest 2. It was on one of our day trips or weekend trips to Chicago. And then on the far right, my husband and I, it's hard to see, we're in the upper left-hand corner there, but we've been doing some fundraising for our daughter's cheer trip to nationals, which includes working at Brewers games. So that has been interesting. Long hours, but fun. So we've been working a few Brewer games this summer as well. And that's us.
All right, thank you, Sarah. So we're going to be jumping into the good stuff now, the one big beautiful bill. And one thing our team likes to say is they like to throw each other into the fire. So this is my first time presenting up here, so bear with me. This is going to be awesome. Yeah. Oh yeah. So One Big Beautiful Bill Act, my portion here is going to be covering what's ending like right now before 2026. So we're going to jump into it. First thing I wanted to talk about today, the EV tax credit that's been around for the last couple of years. So what that was you could get a $7,500 credit on new electric vehicles, and the limitations being the income limit was $300 for married filing jointly and $150 for single. And then the smaller rules inside of that was the MSRP cap on those new cars was $55 for cars and then $80 for SUVs and trucks. And then you could also get a credit for used electronic vehicles with the income limit on that being 150 for married filing jointly, 75 for single, and then the MSRP cap on that was 25 grand. So the rules, according to the One Big Beautiful Bill, are now vehicles purchased before September 30th are still eligible for the credit on this next tax return, but any vehicle purchased after that, you will no longer get that kickback. Next, we're going to dive into the home energy and solar credit. So this was also in place. You could claim 30% of the cost of installing qualified clean energy systems in your home. This also included labor costs, and just a couple to list here. We got solar panels, solar water heaters, geothermal heat pumps, wind turbines, fuel cells, and battery storage systems. This is going to be ending here December 31st of this year. What that means is the installation has to be completed and placed in service. You can't just buy it and not have it installed yet to still get that credit. And then another thing we're going to look at here is the credit carry forward. If your tax liability was smaller than the tax credit you received, the tax credit can still be carried forward to the next tax year. Does anybody have any questions?
It's just a question. So I got my solar panels on, but getting my credit, like, is there a chance that I'll still be able to continue that credit?
Sure. No, that's a good question. So if the credit you received was larger than your tax liability for this past year, the leftover credit you can carry forward to the next tax year until that's used up. That has not been taken away according to the bill yet. So good question. All right. And then just another thing we're going to highlight quick, miscellaneous itemized deductions. These were taken away back in 2018 with the Tax Cuts and Jobs Act. We're just reiterating that they are still gone according to the One Big Beautiful Bill, now with no, permanently gone. So just to quickly highlight, we got unreimbursed employee expenses, certain tax-related expenses, and investment expenses as well. Lastly, here we're going to highlight the Affordable Care Act and what's going to be ending there. So over the last couple of years, what's been allowed is that low-income individuals making under 1.5 times the federal poverty level would pay $0 in premiums for healthcare, and then those in the middle income families, like up to that 4 times federal poverty level, they would pay no more than 8.5% of their income in premiums. This will be ending at the end of this year. Another big thing to highlight is they are eliminating auto re-enrollment for those receiving premium tax credits. So kind of cracking down on that. And then the enrollment period is shortened. Currently it goes from November 1st all the way to January 15th. They're cutting that back a month now to December 15th.
Just another question. So can you go, I think the next slide shows me the poverty limits. So what happens if I exceed that poverty limit? Do I still get my credit, or what happens?
That's another good question. So now the subsidy cliff is back. If you go over our 4 times limit here, you can see the numbers for the number in your household. If you're over that, you get kicked off the cliff. There's nothing. So good question. We got a little skit for you guys just to apply what we learned, okay?
Good morning.
Just to set the scene a little bit, Justin here's the client. I'm going to be his advisor. He's been waiting all his life to buy a new electric vehicle. The new Tesla Cybertruck, we see that there, that hit the market, and he's been just chomping at the bit to get it. So.
Good morning, Logan. Thanks for meeting with me. I don't know if you've been watching the news, but this One Big Beautiful Bill Act was announced on July 4th, and I think the EV credits for cars are expiring at the end of the year. Is that true?
Yeah, Justin, that's right. And actually, I'm really glad that you brought that up. I see on our agenda here today, we're discussing a new car purchase. Are you by chance bringing this up because you're finally ready to pull the trigger on that new Tesla Cybertruck? I know you've been saving for a while, and with the changes coming to the EV tax credit being removed at the end of September, it looks like we're kind of running out of time.
Yeah, you know me too well. I know You might think I don't like car dealerships, but that's not true. I love car dealerships. I love the stale popcorn, the free sodas, the dealership fees, extra warranties, packages, gap insurance, the slimy car salesman, the finance manager in the back room. It's a good experience. And so I'm pretty much set to go, but I need to make sure and ask my trusted financial planner and make sure I can afford the truck.
Yeah, I'm glad to hear you say that, and what's not to love about car dealerships. So, Justin, I can confidently tell you that after reviewing your financials, you are in a place where you can in fact afford the Cybertruck. But be sure to make this purchase before September ends, because according to the One Big Beautiful Bill Act, this tax credit will not apply to vehicles purchased after September 30th. As long as you purchase the vehicle before September 30th, you can claim that $7,500 deduction on your tax return for tax year 2025.
I'm a little confused. You keep calling me Justin, but my name's Brad. If I was Justin, if I was getting a new truck, I'd be getting a Ford F350 with a Power Stroke diesel with rock lights in the wheel wells. Come on. All right. So thanks for the advice. Just a couple other questions clarifying. My wife was scrolling TikTok like she does all the time, and she saw something about income threshold limits for the tax credits.
Sure. Yeah, that's a good question. So you are all good as far as that income threshold goes, because your wife and you make less than $300,000 a year, and you're purchasing a new vehicle, and the MSRP of the Cybertruck is less than $80,000. You will qualify for the credit.
All right. Thank you so much for the advice. Always appreciate it.
All right.
Question.
What is MSRP?
Like this.
Manufacturer suggested retail price.
Of course.
The sticker price.
All right, guys, we got one more skit for you, too. This is going to be just touching on the miscellaneous itemized deductions that we mentioned before. So Kaylee here, she's going to be coming in for some questions about what itemized deductions are, what still counts as itemized deductions, and then the situation, Kaylee has not filed her taxes since 2017, so she's not aware of the current tax brackets or the higher standard deduction, kind of all those changes. So, yeah.
Hey Logan, thank you for meeting with me. I must confess though, I'm a little behind the ball. I haven't filed my taxes in a few years.
Sure, yeah, that's okay. No judgment here. How long has it been?
Only a few. I think I last filed in 2017, so maybe it's been more than a few.
Okay, yeah, 2017, that's, better late than never though. You haven't heard then about the change in itemized deductions or the standard deduction, according to first the Tax Cuts and Jobs Act, but then now with the One Big Beautiful Bill Act here.
I don't even know what those words mean. I feel like you're speaking Spanish.
Okay, yeah. So President Trump, back in effective 2018, he came out with the Tax Cuts and Jobs Act, nearly doubling the standard deduction. And that standard deduction is your allowance from the government that allows to not be taxed some of that money. So, and he also changed items allowed for itemized deduction, including state, local tax, tax prep costs, investment management fees. And a lot of these changes are staying in place now with the passing of the One Big Beautiful Bill Act on July 4th, 2025.
Okay, that's great and all, but why does it matter? What does this mean?
Well, Kaylee, because you are filing as single status this year, your standard deduction will be substantially larger than it was the last time you did your taxes, which in 2017 was $6,350, and then now for tax year 2025, that's going to be $15,750. So that means you can deduct $15,750 from your AGI, and then Uncle Sam doesn't get to touch any of that money. Because the amount you itemized on your return is smaller than your standard deduction, we're going to take the standard deduction, the greater of the two. So this is great news for you.
Thank you for explaining that to me. What about all my itemized deductions I used to take many years ago? I used to be able to deduct the cost of my tax preparation and my investment management fee. So what the heck?
Yeah, Kaylee, another good question. So once again, back in for applicable to 2018, the Tax Cuts and Jobs Act eliminated those itemized deductions, and then now the One Big Beautiful Bill Act here has removed those with no end date. So those will no longer be itemized on your tax return. But on the bright side, your standard deduction is still larger value than you itemizing even those fees. So you're still benefiting.
Okay, but I think I still got a little bit. So can I still have itemized deductions?
Yes, itemized deductions, that's still a thing. But those specifically, and then just to name a few more, it's like certain unreimbursed employee expenses like vehicle expenses, travel, lodging, certain work clothes, tax-related expenses like tax preparation, filing fees, tax advice fees, and then like an investment management fee, those can no longer be itemized.
Okay, got it. Thank you for keeping me up to date.
Of course. I'll see you at this time next year. Let's maybe try not to get 8 years behind on taxes, yeah?
We could make that possible.
Okay, just a reminder, so we're doing some skits here to break things up, but our format is Logan went through the things that are ending. I'm in the middle section. We're trying to picture this as a timeline. I'm taking the items that are extended and modified, and then at the end we're to go over the new things. So things that are ending, things that are extended, and things that are new. Okay, so if you've been to a education event formerly known as a Lunch and Learn in the last 8 years, you've probably seen me talk about the Tax Cuts and Jobs Act and the tax brackets. And the tax brackets 2017 and prior, which if they did nothing at the end of 2025 would sunset and go back to the prior higher tax brackets. So I've been warning everybody, if they do nothing, we're going to go back to higher tax brackets. Well, they did something, so we don't really have to worry about that as much. So as a reminder, I pulled this from one of our trusted sources. This is from an article back in 2017, and this visual chart goes over the old tax brackets. So the ones that are most significant to most Americans are the 15% bracket and the 25% bracket. Those were reduced to 12% and 22%. The 15 to 12 is a 22% or is a 20% reduction in taxes. You can see it was higher in the current law back then. So we've extended the lower tax brackets. So even if you're up in the 24% bracket, it's a graded income scale. So all of your income goes through the lower brackets first. So this is really good news. We've extended it permanently. All right, the other most significant things, standard deduction, they mentioned it a little bit. So the larger standard deductions from the Tax Cuts and Jobs Act extended with the big beautiful bill and actually gone up just a little bit, but bigger, much larger standard deductions. So what this means is less people can itemize, but it's less bookkeeping and most people get the benefit of this larger deduction. So these were adjusted for inflation and they're permanent going forward. So this is really good news. I'll summarize this for you. And as you see my slides in the presentation, I have quite a bit of detail that we took from a trusted source. I tried to bold the highlights. So this is the extension of qualified business income deduction. So this applies mostly to small business owners, so self-employed people, S-corps, pass-through entities. So a lot of small businesses in the country this falls under. Again, a 20% deduction of income. So this is very good. This was extended. And then this is just talking about the phase outs. So if you get up to higher income, it does phase out the 20% deduction for qualified business income. This is also another positive thing. So the gift and estate tax deductions and exemptions and exclusions all got made permanent and increased a little bit. So prior to 2018, the lifetime limit per person was 5.6 million. That got pushed up to 11.2. They've now made it 15 million going forward. So that is very positive. There was people with estate plans to avoid estate and gift taxing rules when they were at the lower limits. So many small businesses, farmers, different people like that in America where they had potentially federal estate taxes, the limits have been permanently raised going forward. So this is really good news. A couple other, so mortgage insurance premiums and mortgage interest. So a little bit of background for those who do have enough to itemize. You can itemize your mortgage interest as a deduction. Many people know that, with up to 70 or 750,000 of original principal on the mortgage. So that's been the same throughout. Some people, if you don't have a full 20% down payment, some people opt to get private mortgage insurance instead of take a higher interest rate. Since 2022, you have not been able to deduct that. Now they're rolling that back in where you can deduct that going forward. And that's permanent. So that's positive for people who can itemize. Here's one that's going to apply to quite a bit of people. So there's a bunch of people that are just standard deduction. We got the larger standard deduction. That's good. Now, to one of the most controversial things in the Tax Cuts and Jobs Act was the limiting the state and local taxes, also known as SALT. That's a nice acronym for you, Dave, if you're still here, or later I'll go over it with you. So they limited state and local taxes, so property taxes, state income taxes, things like that. Some places have city taxes. They limited those to $10,000 of a deduction on your taxes. Well, with the big beautiful bill, they increased that cap to $40,000. So you can see that, and that's starting this year in 2025. They index it up for inflation a little bit each year. And then it expires in 2030 and it goes back down to 10. There are a few of these things. Interesting, this really has nothing to do with planning. Interesting political moves they've done. So they put this in, and we'll go over some of the changes to the $6,000 deduction for seniors. They'll go over that new things. Interesting, they put this extra deduction limit of $40,000 in here, and then they have put an expiration date. So they've kind of like put it in there, and then it's up to Congress in the future if they're going to extend it or change it. So you can see how some of these things creep in. You give someone an allowance for a little while, and then are we going to take it back? So it's just interesting to see how these things kind of evolve and how politics works. Child tax credit. So 2017 and prior, a quick history lesson. So the child tax credit was $1,000, if anybody remembers this, but you had personal exemptions of $4,000, which sometimes got you to an extra $1,000, but most people in the 12 or 15% bracket didn't get you there. So they extended child tax credit permanently and made it larger to $2,200. So this is very, very beneficial to families with children 16 and under. So this is very pro-family. And then they've got the similar phase-out rules as they had. So this is very, very good for working families. Alternative minimum tax. This is a very complicated thing. So I'm going to spend zero time on it. And it's the alternative minimum tax. I'll give you the summary. Has been around for a long time, and basically what it says is if you're able to itemize, you have these itemizations, but if they track your income over here in another bucket, and if your income's over here, then they start to say, oh, you can't take all those itemized deductions, and there's a phase out. So it's like a phase out on top of the itemized deduction, so it gets very complicated. Hasn't been as with the higher standard deductions, it hasn't touched as many taxpayers in the last 8 years, but it's always been there. So they've extended some of the higher threshold limits and going forward. So they've made some tweaks to it, but I'm not going to spend much time because it's very confusing. All right, so that wraps up what is extended and modified. And again, this doesn't cover everything, but we tried to hit on is the handful of things that most people are going to experience going forward. So with that, we'll move on to new items.
All right, now we're done with the history lessons. Let's get into the fun stuff here. So, what is new and what's coming? So let's get into it. First change, so Brad and I are going to kind of tackle this together. A bunch of different new items coming through, a lot of new information. There's maybe some information on there that we don't know all the details of yet, more coming with legislation, but we're going to try to cover as much as we can. So first item I have up here is updates to 529 plans. 529 plans are education savings accounts for children. We as advisors, we've been seeing a lot of changes and a lot more flexibility with these 529 plans, so it's becoming even more flexible now with the One Big Beautiful Bill Act. So with this change coming, starting in 2026, the annual tax-free withdrawal amount for K through 12 expenses is going to increase from $10,000 to $20,000. So prior to that, you could only take up to that $10,000 amount per year without going over that threshold. So that's doubling at this point. Included in that are more qualified expenses. So there's a slew of qualified expenses out there that you can use for these 529 plans to be tax-free. This bill passing added on some more expenses to that limit. So these are distributions after that July 4th date of 2025. So going forward now. So these qualified expenses include curriculum materials and books, tutoring, standardized test fees like your SATs, your ACTs, and your AP exams, and then dual enrollment fees for college courses while you're taking those in high school. And then we finally have educational therapy for students with disabilities, as well as credentialing programs for trades, so welding, HVAC, CDLs. I can tell you when I was in high school doing a lot of the expenses came through these standardized test fees as well as the dual enrollment fees for college courses. So we're seeing a lot more flexibility with these accounts now. If I had that back when I was in high school, that'd be huge. Those test fees and those courses start piling up on you. So it's just a lot more flexibility that we're seeing with these updates to the 529 plans. So that's our first update here. So next one, overtime. You guys might have heard all of the rumors out there with how overtime is being treated tax-wise. Might have heard of rumors that it's being overtime tax is being eliminated fully. That's not the case, but we do have a lot more flexibility with overtime pay as well. So there are updates. So for tax years of 2025 through 2028, overtime, you may deduct a portion of that exceeds regular pay. So when you hear people say, I'm being paid time and a half for this overtime, if you work a holiday, working on Christmas, I'm getting paid time and a half, that half portion, that's the portion that you can deduct, not that full time and a half. So that's that half portion. There are also maximums to that. So it's not all of the overtime that you're going to make throughout the entire year, there's only a portion to that. So that maximum annual deduction is $12,500 for single and $25,000 for joint filers. So there is a cutoff period to where anything over that amount, that overtime is still taxable. So we're not completely limiting that amount. So, yes.
Where I work, there's a program where when we're short staffed, it's a bonus program, you can earn up to, like in my case, $45 more an hour, if I pick up these hours. Would that fall under that too? Even though that's not necessarily half or time and a half?
Yeah, so the question was, there's a program out there where she receives an additional $25 an hour or so, but that may not be overtime. That may not be overtime in and of itself. So we're still waiting on all the exact rules for that, and that might vary from employer to employer exactly how that program is set up. So it may depend on the situation. We can look into that. So then finally, our third point on here, there is a phase out range as well. Phase out range for taxpayers is an adjusted gross income over $150,000 for single and $300,000 for joint filers. So after you hit that period, there's only a certain amount that you can deduct. So that starts falling off in that phase out. Finally, the deduction is available for both itemizing and not itemizing. So even if you claim that standard deduction, it's not a deduction that will show up on your itemized portion. That's just directly chopped off of your taxable income. So that's our first point with our overtime pay. Yes.
Is that with, are there, specific, jobs that this is for, or is this for anybody?
As far as I know, it's for anybody. But unless you guys have seen anything, there's a lot of unknowns out there. So when we kind of figure out exactly what covers all of this for overtime, we'll let you know. But as far as right now, we don't really know exactly who that all covers. Again, it might vary from employer to employer. Good question. So, yes, right in the middle.
Will the employer keep track of those overtime?
They should. That should show up on your pay stubs, on W-2. That should show up everything, and that should be tracked by that employer. Yes.
So the 25,000 for married,
Yep.
for a joint return, does that 25,000 have to be split, or can it be all from one spouse?
That's total.
Total?
Yep.
So my husband can work 25,000 in overtime, and he.
Correct. Yep. So if only one spouse earns that 25,000, that's okay. So that's 25 total between the household.
Better get working, Tom.
All right. So let's go on to our tips. So tips is the other one that we've seen some rumors out there with the tips being completely non-taxable. Again, that's not the case. There is a cutoff point to that. So here are some updates on how tips are taxed. So again, these are for tax years 2025 through 2028. So tax filers can now deduct their qualified tips. And when I say qualified tips, as of right now, what that means is voluntary cash or charge tips received from customers or through tip sharing. So you work at a restaurant, here, I'll give an example. I used to work at a restaurant in college. We didn't receive a lot of cash tips. A lot of the tips were you get your receipt, you write your tip amount on there. That's calculated through our system. We then receive that on our pay stub. So when I receive that tip amount, that's the amount that they're talking about right here. When it's through just regular cash tips, that's dependent on the employer as well. Are they tracking those cash tips somehow? You may have to track those cash tips just regularly because a lot of people out there, they receive cash tips from whenever. They're not even thinking about reporting that tax-wise. So that's kind of the gray area between that. So that's what I found out there with what's actually the qualified tips. Same deal with the overtime. There is a maximum annual deduction of $25,000, and that's for self-employed filers for the deduction that cannot exceed their net income. Same deal. There is a phase-out range again. So phase-out range is that adjusted gross income over $150,000, as well as $300,000 for joint filers. Same deal. Deductions available for those both itemizing and non-itemizing. So even if you claim that standard deduction, you can deduct the portion of cash or the tips as well. Finally, point at the bottom, I just found that out that the employers must file information with the IRS. So you may not even have to worry about reporting those cash tips. The employers might just be able to do that. So that goes back to that example that I showed, is when I was working in college, working at a restaurant, they reported those for me on my pay stubs. So that's how it kind of shows up tax-wise. So any questions on the tips here? Okay. So we do have a skit for you. I'm going to call Chris and Sarah up here, and we're going to get going on that. All right, and just to set the scene here, so Chris and Sarah, they have a situation where they may receive overtime and cash tips. We're going to talk them through and see how that affects their tax situation. So here we go.
Hi, Kate. Sarah and I are really excited to meet with you. We have some items to discuss, and we are hoping that you would share some insight on tax advice so that we can make correct decisions.
Perfect, 100%. So, Chris and Sarah, thank you for letting me know. Thank you for meeting with me. Tell me more about these changes, and we can see what we can do.
Well, I've been sitting around the house too much after work and get so sick of you know who that I just needed to pick up another job. This is a new waitressing gig, and it is heavily revolved around receiving cash tips. I've heard rumors about changes with how that's taxed, but don't know where to begin.
Sarah, this is an exciting change, and I don't blame you for wanting to get out of the house. If I had to see that vibrant, obnoxious banana shirt every day, I would want to make like a tree and leave. So I don't blame you on that part. So let's get a plan going after we hear about Chris's change. Chris, what do you got for me?
Well, those of you that know me or don't know me, I've been really looking forward to buying a wood-fired finished sauna and a nice hot tub. And I figured that would be the perfect way for my wife and I to spend some more quality time together. I mean, who wouldn't want to be together and sweat? So in fact, I even pre-bought our sauna hats for this occasion.
Oh, that looks great.
Why do you use sauna
I think you're ready for the sauna.
So, just so happens with this big purchase that I would like to do, my employer is offering overtime, and then I would like to make some extra cash and see how this big, beautiful bill works in our favor to be able to do that.
Awesome. Love the hats. So I'm glad you guys asked, gave me those updates. First of all, Sarah, how much do you anticipate receiving in cash tips this year?
It's a rough calculation, but I will receive around $15,000 in qualified cash tips.
That is great. And Chris, how much do we expect in estimated overtime for you? I know it's tough, but just give me a rough number.
Whatever it takes to get the sweat going, but I'm figuring around, let's say, about $20,000 in overtime.
Okay. So that sounds good. Again, like I explained during the slides, although we don't know the full details right now, you should be able to deduct both of those full amounts as they are under those thresholds that we talked about. So again, those thresholds were $25,000. Sarah at that 15, Chris at that 20. So we're under those thresholds. I was able to run a tax planner with both of those amounts based on that situation. And let's see the comparison before and after the One Big Beautiful Bill Act. So before the bill, our total W-2 income was at that $135,000. So that's at the $50,000 for both of you, as well as those additional amounts. Before the bill, our standard deduction was at $30,000, and our total tax liability, way on the right there, is $12,928. So that's how much total income tax we're paying on all of that income amount. So now let's see what we're looking like after this bill. So after the bill, we get to deduct those full amounts. Our income drops to $100,000. So that $20,000 and $15,000, we're down to that $100,000. Standard deduction. We discussed that before. That got a slight increase. So now we're at that $31,500. When you run those through those tax brackets, our total tax now, after all of these changes, is at $7,746. So that's a tax savings of $5,182. So we're looking good there.
That is amazing news. That sounds like a whole lot of opportunity to spend more time with my lovely wife.
Agreed. That is great. Maybe with the tax savings, I can take a trip to get out of the house and away from hot tub guy over here.
I don't blame you. This is just one of the ways that we can help tax plan the situation. It is important to keep in mind these changes only last through 2028. So it is good that we're making the most of this change. Thank you.
Thank you.
Well, that was some exciting stuff. So we've got the cash tips that are reported, all that good things. So another thing that's out there, you guys know me as I'm letting more people buy cars that are my planning clients. So this was pretty exciting for me to find out that there's no tax on car loan interest. And yes, that's a little controversial. It's in the IRS publication with this heading, so I wanted to use it. what does it mean? In 2025 through 2028, you can deduct up to $10,000 of interest on your car loan. But then there's details. So can we get a used car? No, it has to be the first person owning it. Can it be leased? Lease payments? Nope, doesn't work. Can it be a big, over 14,000 pound vehicle? No, can't be that either. But, I'm a big fan of Honda, so you could get that Odyssey and roll in that and deduct the interest. Because I know it's a lot easier to get in and out of those things, and they do haul a lot of things really well. The loan did have to originate after December 31st, 2024, so your old loans don't count. I'm sorry. I didn't write the rule. I'm just giving it to you. And there are phase-out limits, so married filing joint, $200,000, or $100,000 for anyone filing single. So it's a lot of excitement, and that is what we know. Oh, we got a question.
So you're telling me since I bought my new car in 2024, I'm missing out on all these opportunities?
Oh, 2024? Was it after December 31st, 2024?
It was. So do I get my interest deducted
Yeah,
now?
no. Yeah, it doesn't seem fair, but before she got the car before December 31st, so it's not effective. It's not retroactive back to an old car loan, and you can't go refinance it because it's not a new car then at that time. So, couple of rules. Good question, though. All right, the charitable deduction. If you guys remember back during the COVID time, there was this like $150 or $300, $150 cash donation that you could deduct on your taxes. That ended in about 2 years. It was there and then it was gone. They're bringing that back in 2026. So if you do standard deduction, you could deduct $1,000 for single filing, $2,000 for married filing joint on your taxes if you don't itemize. If we all remember Schedule A, because we big on taxes, so everyone knows all the schedules. That's good. But that's medical expenses, mortgage interest, the SALT that Justin talked about. Charitable donations is another one of those. So on that schedule, though, going forward, there will be what's called a 0.5% floor. You might remember this of the 7.5% when you get medical. Your first 7.5% don't count. After that, you can deduct. Same thing on your itemization. So if I had an adjusted gross income of $200,000, I'd donate $15,000. That 0.5% of that would be the first $1,000, wouldn't count, and then I can deduct the other $14,000. So just something to be aware of as you're thinking about that. And all of this relates to Schedule A. So those of you that do qualified charitable distributions, all that's the same. And this. So everyone asks me, what happened? No tax on Social Security. I found this picture. So if it's a picture, it's on the internet, it's got to be true. So what happened? But what we found out is starting in 2025, those of you that are 65 or older, you would get a $6,000 additional standard deduction. Okay, so we talked about $31,500 for the regular standard deduction. It does, I think the overall, if both of people are adjusted gross income of $150,000 married filing joint, and you get your additional thing, it's a total of $46,700 of income that you would deduct and not pay tax on. So there are phase outs of that as you move along. It's 6% of adjusted gross income, and it does require a valid Social Security number. So I hate to break it to you, this picture is not true. Yes.
That applies if you're 65 or older and still working, or 65 and older and collecting Social Security.
Right. So maybe there's a benefit there because it applies 65 and older as long as you're in the income thresholds. You can still be working and you may not have Social Security turned on because it's a standard deduction, not a no tax on Social Security.
And then, okay, so it's adjusted gross income of 75, that's after what is currently standard deduction and then the 6,000, or if that's 6,000 after?
Yeah, so adjusted gross income is, I don't know, Kaylee, line 8 or line 7, I forget, or no, line 11. Whatever it is, it collects up all your income. So as soon as that's at 75, that's the most you can have. Then the deduction comes off and it's stacked on top of your standard deduction.
Okay.
So, yep, good question.
Justin.
Yes, Justin.
Brad, is it true that Wisconsin passed something on exclusion of retirement income too?
Ooh, that's a good question. So, those of us that are Wisconsin state residents in the filing status, there is a new component that was passed. That total, I want to say, is pretty hefty. And again, I hesitate a little bit because we like to do it in our tax planning software and it hasn't quite made it in there yet, but it was offering like a $24,000 exclusion for those who were 67 and up. So more to come on that. Justin and I are handling it delicately, just in case. So I'm going to call it the surprise bonus. If you get a surprise bonus refund in the state, it came. All right, so good news. Chris came back. He's now married to Emily, so this is good.
This is my third wife of the day.
And they are, they're retired. They got an adjusted gross income, $110,000 in 2024. They've got a large IRA balance, and they have some questions.
Hey, Brad. Chris and I have been talking to all our friends about the big, beautiful bill, and we want to know how it affects us. I want to spend more money on the kids, and Chris is telling me no.
Well, I'm glad that we, got this chance to sit down and discuss things. There's quite a few changes that are effective immediately. Last year, for your situation, we took about 70 grand from the IRA to pay for some bigger purchases. So far this year, we've only taken a 50,000 out. Are there other things you're planning?
Well, like Emily had said, she wants to spend money on the kids, and I say, no way. I want to we have to take care of the roof on the house for sure. But then I also want to get a tri-tune with a big motor on the back, and I want to cruise around the lake. I'll even cruise around while it's on the trailer. I don't care.
Wow, that sounds great. Emily, is there anything that you're looking at this year?
Well, I also want the new boat. It would be great to pull the grandkids on tubes. And I wanted this big area for people. We can all invite all our friends. It'll be super fun. Chris can even fish from it. Yes.
Now that sounds like more than we normally spend. I know Chris is big on staying in the 12% tax bracket. Did you have a ballpark amount of how much you were going to spend?
Well, between the roof and the boat, obviously I'd want to spend more on the boat, but we need approximately 31,000 on this.
Okay. I think that number could be doable with these new changes. The standard deduction increased by $1,500, and with your glorious ages and your adjusted gross income below 150, you're going to get that additional 6,000. So by the time we take the taxes out on all that, I think that'll give us the 31,000 that you need.
That is great. I am super excited to spend more of our money. And I love spending time with the grandkids, and this boat will be great. Yes.
I hope I get a ride.
Happy wife, happy life.
All right, we have one last section to go through as we're running short on time. I'm not going to spend a lot of time on this. So what this new changes are new Trump savings accounts. So these are new Trump savings accounts for children born between January 1st and January 1st, 2025 and December 31st of 2028. So each child born between that time, they will receive a one-time $1,000 federal deposit into these new Trump accounts. There's a lot of unknowns and gray areas behind these accounts, but here's what we know so far. So we have the initial $1,000 federal deposit. We have a maximum $5,000 additional yearly contribution. Those are only allowed starting next year, July 4th, 2026. So those contributions are can be so that each parent's employer can also offer up to 2,500 of those contributions, and that is included into that $5,000 total contribution. So employers can make matches onto that, and I'm going to give you an example here. So Dell, the computer company, pledged a $1,000 match for its employees for those children's Trump accounts. So that $1,000 match that they're receiving, that does count towards that total $5,000 contribution. So funding is only available while the child is under 18, and the funds will then be available for the child when they turn 18. There are some conflicting points with how those funds can be used. What we see, it depends on which type of contribution it is. So it's going to have a mix of a couple buckets tax-wise in there. So first bucket is going to be that initial $1,000 federal deposit. So that federal deposit is tax deferred. So whenever you take that initial deposit out, as well as any earnings on that, you pay income tax on that. You can't take that out, or the child can't take that out until they're penalty free until they're 59 and a half. So it works very similar to a traditional IRA. Then there's another bucket. The bucket is any kind of parent contributions. Those contributions are made post-tax. So any contributions that the parents make, if they do this $5,000 contribution annually, you can take that amount out just like Roth IRA. If you put money into a Roth IRA, you can take that basis back out. So it depends on the different types of buckets, what you put in, and then how you're taking that out. So there's a lot of gray area between how you can use those funds and how that's going to be taxed. So we're kind of still waiting on exactly how these accounts are going to work, but this is kind of what we know so far. Investment options at the bottom are limited to exchange traded funds or mutual funds within the U.S. with an expense ratio of less than 0.1%. So low cost index funds within those accounts. So the investment options are very limited until the child turns 18, and then they can do whatever kind of investment option out there like a traditional IRA would. Skip to our next slide. So we kind of covered no distributions allowed until the child turns 18. After that, account will be treated like a traditional IRA. Withdrawals can be made for higher education, small business expenses, and first-time home purchases up to $10,000. So that's the similarity that we see with that is like with a Roth IRA. You can take out even earnings if they're for special expenses. So in this case, it's that higher education. It's the first home time purchase like an IRA would be. Couple other points on here. Contributions can be made until December 31st. All other withdrawals will be subject to a 10% penalty until the child reaches the age of 59 and a half. We kind of covered that already. So these accounts, we're kind of seeing a mix of both individual accounts, IRA, Roth IRA. It's kind of a mix of between, but they're in place for the child to start saving for retirement. I don't necessarily see the benefit of it for an education account. It's kind of more to get more funds into the market for the child to have it grow up until retirement. That's kind of what we're seeing on it a little bit more. Last point is I just have a few points on here that are unknowns. So unknowns is it seems the government will be opening these accounts automatically for those born in between that time period. How they're going to open that, we don't know. I've heard rumors on there. You check a box on your tax return, and then that automatically enrolls them into that Trump savings account. Again, it's going to be kind of trial and error with this. Let's see how it works as more information comes available to us. Second point, how do you claim the $1,000 initial contribution? Same deal. There may be a box where you check on your taxes where you claim that $1,000. I've also heard if January 4th of next year going forward, when the child's born, that automatically sets that account up up for you and you automatically get that $1,000 federal deposit. Again, kind of waiting on the logistics of that. Finally, the last 2 points, how are distributions allowed before the age of 18, and how are distributions handled after the child turns 18? So again, it's going to be a lot of just waiting around, waiting for legislation to give us updates on these Trump accounts and how they're going to work going forward. But just kind of quickly wanted to touch on these new accounts that are going to be coming available for children's savings. So going forward, I will then hand back over to Justin, and we'll kind of wrap up. Yes?
Where's the money deposited?
So when I was looking at it, you can do either a bank or some financial institution. How that works, I don't know. So we'll have to keep in touch with, where exactly is that account being held? Is it being held at a Chase Bank? Is that being held at a Charles Schwab, a Fidelity? I think either options are available. If you do the automatic enrollment process, you may be able to state, this is where I want that account to be held, and that's how it's set up.
Okay, we've all seen these before. So first time Trump was in office, we thought we were going to be able to file our taxes on a postcard. Those are some fun press meeting pictures. So then we got a quote up there. I don't think you're going to be able to file your taxes on a postcard. Who's that quoting? Anybody know? Paul, do you know who that is? Me! When I was interviewed by WISN. Along with what do I do with my hands? Remember? All right. So we definitely have some good extensions on the tax law code and deductions and lower tax brackets extended. So those are good things. I don't think we're making it simpler though, because now we have Brad and Kaylee. How many schedules do we have? 7? And there used to be like 2 or 3. So I don't think we're making things simpler, but that doesn't necessarily mean not better. Okay, so before we do normal wrap-up things, just want to do a high-level wrap-up. So the One Big Beautiful Bill Act delivers tax benefits to working families. So a couple of highlights: households earning less than $100,000 get at least a 12% tax credit, like when you do all the math on all the things, how they're affected. Again, we extend lower tax brackets from the Tax Cuts and Jobs Act of 2017. We lock in larger standard deductions, increasing them to $31,500. We extend those qualified business income deductions. We increase the SALT deduction to $40,000. We increase the child tax credit to $2,200 from $2,000. That's going to affect about 40 million families. And no tax on tips up to a certain threshold. No tax up to overtime pay differential up to a certain threshold. Up to $10,000 of car loan interest tax-free. The extra deductions for seniors, that $6,000 deduction. So then they've kind of equated some money. This is an article that I found where, hey, this is actual results. Like tip workers will benefit about $1,300 lower in taxes, $1,400 for overtime hours. So that's actual tax dollar savings to the average worker. And then we've revived that old charitable deduction that was $300, $600. We brought that back, and now it's $1,000, $2,000. So with that one, that's why we always tell you. So we've kind of gotten lulled to sleep a little bit. Some people are like, well, do I need to keep track of my charitable contributions and my out-of-pocket medical? And that's why the planning team will always tell you, like, just keep track of it every year. I know it's a little bit of a pain, but we don't know if you're going to have enough each year. And sure enough, people who haven't had enough to be charitably or to be able to itemize, and they weren't tracking their charitables, now you can deduct $1,000 or $2,000 as a couple on top of your standard deduction. So, and then we didn't even cover anything on health savings accounts. There's other, so we just took a small slice of what was in there. So again, and then Kate talked about the Trump accounts for new babies being born. So my last comment before I do wrap up slides is, regardless of your political stance or anything, the majority of what's in here is focused at reducing taxes for middle and working class. So there's no disputing that. Like the deductions in overtime pay and no tips or no tax on tips. So that is really, it's a lot of working class tax cuts, plus extending the tax bracket. So a lot of it is going towards families and working class. So that's good for our future and everybody who's still in their working years and people that are having lots of kids. So that's my comments on that. Okay, so next month we have our adaptive team presenting October. What is the date on the last one? I don't remember. What's the date?
15.
October
15.
15?
Yep.
October. So the third Wednesday in October, we'll have our adaptive team coming up and presenting. And then everyone should have a paper feedback form. Please take a couple minutes to fill that out and turn it into our team. And then most of you are clients in here, but some of you may have brought a guest, which is great. So if you want to explore financial planning, tax planning with us, an initial consultation is the first step. There's no cost for it. We don't do any planning there. It's just an opportunity for us to see what type of planning you may need to do, and then go over our planning process and cost structure. So we went all over all these changes. Everybody's situation is different, so it's hard absorbing this presentation and understanding like how is it going to affect you. That's why we do individual planning for all of our clients. So that is it. Thank you for coming out.